In your opinion, what's the difference between an indicator and a pattern?
Pattern is built when you see the history of the trading instrument. For example, you would need the previous low, previous high in order to build support and resistance. But when the instrument is emerging in the area which is outside of the previous range, you don't have yet any lows and highs. So here indicators come into play.
Hello everyone, and thanks for tuning in for our weekly episode of Exness Trading Talks. Last week we discussed about trading mistakes when using indicators, and this week we're going to be discussing on patterns versus indicators. If you haven't done so already, please like and subscribe to our channel to be amongst the first to know about the new release of our episodes. My name is Antreas Themistokleous, and today with me I have Stanislav Bernukhov. Hello Stan.
Hello Andreas.
So patterns, indicators, what are the differences? How do you distinguish between the two of them?
So pattern is a visual thing that is recognized on the price chart, right? Indicator is a computational model, if you can say that, which helps a trader to also visualize trend or visualize the border of a trading range or something else. So basically it pursues the same goal, right? Simplifying the picture and cutting the noise out of the picture. So they serve the same goal, or they pursue the same goal, but patterns, they narrow down the possibilities or your choices to, for example, the trend line or support, resistance, something like that. So patterns do not involve such active decision making. Indicators might flash buy or sell signals, more frequently in the case if trading decides to take signals. Patterns, they were developing in the trading domain, far before indicators were invented, because, starting from Charles Dow and then proceeding to Wyckoff, to, Elliot and other, people who were inventing some, analytical methods. So patterns were existing, long before indicators. Indicators had started to develop since the beginning of computer era in the 80s. And then they have become popular. I would say that combination of both actually makes sense.
Yeah. Some indicators were based or founded based on some patterns, for example.
Yeah.
All right. So in your opinion, how can indicators help validate or invalidate some patterns, for example?
Well, for example, for patterns, you need the previous dynamics, so some history to understand what's going on. For example, for support, you at least need one previous low, right?
Yes.
Build the line. For resistance, also one previous high. Or for trend line, you need several lows and highs going one after another. Indicators might help you when you're operating in a no man's land, for example, and there is not enough data. So moving average, for example, can extrapolate the dynamics in the future to show you where possibly support may appear or, resistance may appear. For patterns, you would need some previous dynamics already established. So you would need a confirmation in order to build a support or resistance. Or let's take, standard deviation indicators or Bollinger Bands or envelopes. So they show you the possible border of the trading range, whereas for patterns, you would need the actual high or actual low to build the support and resistance. So that's the main difference, I think.
Yeah. And also, do you think that indicators to some extent can influence, let's say, sentiment of traders? For example, when we have an overbought RSI on Bitcoin, can that affect to some extent the sentiment and turn Bitcoin traders bearish?
To some extent, yes, but I think they're more indicative rather than predictive. So if there is a bullish sentiment, they will indicate that. That's a good question, to which extent the flashing indicator and the overbought, oversold signal might pull in more traders. So I think that's more a retail type of thing. So I don't think big market participants, they necessarily rely on RSI readings or anything like that. But it's indicative. So if you see the momentum, so it will indicate that. Well, so it's also helpful.
And also, can you name like how can we combine different patterns or indicators with trends or fundamentals to form like a basic strategy?
Yeah, well, let's say you have a trend line, and at the same time you have a converging 200-day moving average. For example, meeting this trend line. So in this case, it's kind of amplified. So you have confirmation from the trend line and from the moving average. So, well, in that case, it's helpful. Or you have a previous low, it's broken, and it's at the same time you have the lower band of the Bollinger Bands tested. So it amplifies your view, because otherwise, if it would have happened inside of the range, somewhere in the middle, so that's a different story. But if you have converging indicator reading and pattern reading, so you have the situation amplified. Or, for example, you have Fibonacci retracement combined with some kind of moving average too, so that's just confirms the picture. So that amplifies.
Yeah, mentioning Fibonacci is one of my personal favorites, and I like to use the Fibonacci in combination with some other indicators like moving averages, especially to formulate my strategy.
Exactly.
Okay, so thank you very much, Stan, for commenting.
Thank you for having me today.
And a big thank you to our viewers for supporting us so far and watching the video until the end. Thank you all for joining us on this episode, and hopefully see you all next week.